Our market monitor tonight says investors should balance the risk in their portfolios with stocks of high-quality companies with solid earnings. He's Jason Pride, Director of Investment Strategy at Glenmead. So, Jason, let's get right to it. You've got a couple of stocks to tell us about, and at the top of your list is Abbott Labs, ABT. Tell us why this fits your investment theme.
Right. Well, first, for the overall picture, when you're taking, and we're recommending taking a little bit more risk in the international markets, a little bit more risk by underweighting fixed income and broad portfolios. In order to offset that, one of the best things to do is to provide stability within the U.S. equity market universe, where valuations are a little bit above fair value, and there are inexpensive, high-quality, stable opportunities that are able to deliver good long-term growth. Abbott Labs fits well into this camp. Very reasonable 18 times earnings sort of valuation, a stable growth story where, if there are any unknowns that come about in the coming year, they're going to be less subject to the volatility surrounding that. And their growth story generally has been a good one recently, with a good number of product deliveries in the right direction, and 9% total kind of general growth for the underlying business, and paying a 2.3% dividend along the way.
Your second choice is Home Depot. Isn't a lot of the nice run there already in the stock?
The valuation is a little bit more pronounced, a little bit higher than what we're getting with the other companies, but interesting. There's that follow through that typically comes from increased home sales, and the home market has been reasonably strong. This is a company with fairly good profit margins and ability to grow from still a lower base because of what we went through over the period following the financial crisis. And therefore, we think that home improvement cycle is still coming about in the company, and are carrying through with that investment.
Your next stop, Accenture, ticker symbol here, ACN, also has had a nice run from about $70 a year ago. It's $82 now. Tell us why you like it.
Well, again, going back to this kind of baseline thought process, we want high profit margin businesses, stable businesses. Accenture is a little bit different from the other two. It's a cheaper valuation. It's a more globally oriented business that will move a little bit more when international markets, developed and emerging market, fluctuate on you. But we think the growth story is interesting there. They are pushing an overall technological consulting franchise out into those international markets and really gaining a lot of share through through that process. It's a good growth rate with, again, good dividend yield and a nice solid 17 times normalized earnings from our perspective.
And apparently brought in today by the government to help pull the website, the healthcare website, along. Very quick thought here. Should we be...
We'll hope that works out.
We'll hope that works out for all of our sakes. Very quick thought here. Should we be worried at all about the kind of halting, stumbling start that blue chips have had at this beginning of the year?
We think it can occur. There's definitely always the possibility, and every market year has its fluctuations up and down, and it's drops down lower. So we think investors should position themselves in a way that if that drop comes for some reason nobody can really figure out exactly why it would happen, that you're positioned to add. But from our perspective, even after the 30% run last year, valuations are reasonable, and returns are probably going to be pretty decent from this point forward.
Okay, a lot of good information. Jason, any disclosures to make on these three stocks you recommended?
Sure, Glenmead's a holder of all three of them, but I am not personally, and we have no investment banking relationships.
Okay, good to know. Thank you so much. Jason Pride, Director of Investment Strategy at Glenmead.